So, good morning, everybody. I'm Dan O'Cabbage with Mortgage Master. We have an office right on Nassau Street in Princeton, and today I'm just going to talk to you a little bit about some loan programs that can help you sell more homes. As you know, the market's super hot right now, and there are some people who might need to fit into these parameters that aren't conventional, approved, or certain things like that. Let me tell you a little bit about Mortgage Master. We are a privately held company. We don't have shareholders. We don't have one set of rules to listen to or play by. We work with many different investors. So we're allowed to take each case-by-case basis with each client and find the best position for them. So not to name any names, but the big banks play by the big banks' rules and their rules alone. A little bit about us, we have closed and funded in 2010. We don't have all of our final 2011 numbers to share. But in 2010, the company funded over $5.5 billion worth of mortgages. That's all we do, mortgage specialists. We don't do checking, we don't do savings, we don't do CDs. We are mortgage specialists. I do know that the first quarter of this year, we closed over $1.6 billion, so we were super busy. Appraisers, super busy, so it's really, really great. 22 years in the business. As far as the company itself, we have more of the top 100 loan officers in the entire country as far as closed volume. And we do business in over 20 states. I primarily focus on the New Jersey area itself. And we are not a broker shop, so we don't send the file out to an underwriter to get originated and closed and approved. We do everything in-house. We fund the mortgages, and then after closing, the loan gets transferred to the investor, whoever that may be. So we'll start right off and get into the one that really is my bread and butter, no income verification loans. We still do them, believe it or not. You do need a 720 credit score. You do need 40% down, so it does require some skin in the game. It is a primary residence only. We used to be able to do second homes, but they took that away from us, unfortunately, because that was a big winner along the shoreline. You do need 2 years of employment history. Now, that means you could be self-employed. That means you could work at Starbucks as long as there are 2 years of history of employment. Where that really helps a lot of my clients, A, are the self-employed. We all know what some of their tax returns unfortunately look like. And the divorce situations, husband or wife is a CEO in New York and makes $500,000 a year. The other spouse is working at Starbucks or kiddie daycare or wherever the case may be, and they've got 2 years of history. The buying out spouse, divorce decree, property settlement agreement, we can show verification of where the funds come from. So we do have to verify where the assets are coming from, but we don't verify any of the income. All we verify is that they are employed. So that really helps that situation of the person who hasn't been receiving alimony for 12 months, which are the guidelines for the conventional mortgages. Child support hasn't been receiving, maybe they just got their first child support and alimony check. So those programs really help because we don't have to verify where that's coming from. We don't even put a dollar amount on the loan application. Most importantly is we do not have a 4506 form. I don't know if you're familiar with what that is. With every single mortgage that is originated, conventional FHA, traditional mortgage, there's a 4506, which is an IRS tax transcript form. We send that to the IRS as an industry. Every single one of us sends that to the IRS. If their tax returns say they make $1 million and the transcript says they make 100,000, somebody added a couple extra zeros. So we match those to make sure that everything is legit and clean. So what will happen is sometimes that 4506 on the self-employed individual will come back and they've got way too many deductions or whatever the case may be, and they're not able to actually approve for the mortgage. We don't have that 4506 form. We don't submit it to the IRS, so there's no question that that income is going to be an issue. So the no incomes are really I do about one a month. Just simply because there are a lot of people who fall into this category, divorces, etc. And it really is something that's helping us sell more homes. when you get in that position where, you know, you get in the contract and then all of a sudden you get a phone call, my lender's got a problem with my tax returns. That's the worst phone call you're gonna get. Hopefully the worst phone call you're gonna get. And so those are some really good programs. Now, a lot of people ask me interest rate. What do the interest rates look like? They're actually not too bad. They're low fives. 30-year fixed is 5.25. You know, APR is a little bit higher, 5.3, 5.4, because you do have the closing costs that we calculate into the APR. A lot of people like these for like the 5-year adjustable rate, where it's fixed for 5 years. That's in the high 3s, low 4s. So, you know, there are a lot of different things that we can work with that. It's just not a 30-year fixed program. We do not allow interest onlys on these, and we do not allow you to waive your escrow. So you do have to pay your taxes and your mortgage payment, because if we're not verifying your income, we got to make sure that we're paying your taxes, that we're paying your taxes within your payment. Okay? Any questions about the no income loans? All right, great. Next thing that we're having a lot of issues with that I see in the industry are condos. I'm sure you may have seen that yourself. Condo issues such as litigations, special assessments. More than 15% of the homeowners in this economy, we're seeing a lot of this where they're delinquent on the association dues. So if you have more than 15% that are delinquent, that's a red flag on a condo questionnaire. We have a no condo questionnaire mortgage program. It does require 15% down on a purchase, and those monies can all come from a family member as a gift, 100%. Doesn't even have to be their own money. So, you know, when you fall into the more conventional mortgages, you do find yourself where some of it needs to be their own mortgage or their own monies out of their own bank accounts. This can all be from a blood relative, mom, dad, brother, sister, aunt or uncle can give that gift to the buyer, and it could be all the complete 15%. We do need a credit score of 680 or better on these. Okay. Couple caveats. The building must be 8 stories or less. So if you've got a 9-story building and the first floor is parking, they don't care that the other 8 are livable. It's a 9-story building, off limits. Must be 10 units. So 4 units, 2 units, you know, some of the condo conversions, they're not going to qualify into this. All right. For condo conversions, we don't see a lot of this in here around this area. This is more in like the Hoboken area where they've taken a old warehouse and converted it. We may see some of it in Trenton as, you know, some of the revitalizations hopefully continuing. But if it is a condo conversion, it must be 36 months old. It must be 75% complete for the entire project. And then when we have new construction condos, 90% of the phase must be complete and 75% of the units must be sold. Now, many of you are going to ask, well, how do you know that if you don't do a condo questionnaire? Appraiser is going to note those items. We've got to get an appraiser. So, no more than 40% can be investor owned, meaning rental properties. So if there's, I'm just going to use simple math, there's 100 units in a complex. If 41 of them are renters, it's off limit, because that's going to be on the appraisal as well. Okay? But other than that, no condo questionnaire. So we don't know, we don't ask is there litigation, Pike Run. We don't ask if there's a special assessment, Raven's Crest. We don't ask for any of that information. Delinquencies, one person may own more than 10% of the units. Griggs Farm, Washington Oaks, they both have affordable housing. And when we ask the condo questionnaire, sometimes that affordable housing number is more than 10% of the total units. All of a sudden, that's an issue. So when you're coming across that with condominiums, you know, this is a good program. Again, it does need 15% down, so that is a pretty big chunk, I know, with condo owners. But having the option to have a 100% gift can really give that flexibility. Yes, Dave?
I was curious about that affordable housing. Can you explain how that impacts things? I don't understand that.
Mm-hmm. Affordable housing in New Jersey is an animal created by New Jersey, COA. And the COA rules require a certain percentage of housing be affordable. what some towns have done is put all that into one complex. Well, they own the properties, deed, they're the deed owners because they're essentially, if they foreclose, the township has the right to come in and take over the foreclosure before the bank does. So on deed, they are the first right of refusal. That falls into a line of more than 10%. If it's more than 10% of the total units, then that number is going to be a problem on a condo questionnaire. Because first deed of refusal is going to be included in to that 10% ratio on your more traditional mortgages.
So I'm still a little bit unclear on this. So on a typical condo questionnaire, they will not want to see more than 10% affordable units, or?
More than 10% owned by one investor or one individual.
Okay,
That's the question on the does more than 10% of the total units, are they owned by one individual or one investor? And if that answer is yes, red flag gets thrown up. Sometimes we can get exceptions if there's compensating factors, but again, whenever red flags come up in underwriting in today's environment, that's not necessarily a good thing.
And is that for FHA guidelines or just any?
Across the board.
Okay.
Fannie Mae, Freddie Mac, FHA.
And
So that's why this program's super great, because of that particular issue. Yes, ma'am?
But how does that affect the mortgage? If it's owned by, if over 10% is owned by one investor or one owner?
Let's say, I'm gonna use Ravenscrest for an example.
Uh-huh.
They had a huge assessment.
Mm-hmm.
If 10% of the units are owned by one person, that person's taking on 10% of the total assessment.
Mm-hmm.
If they can't afford it,
Okay,
then who else is gonna take over, because they have to still have that special assessment.
right.
So statistically, in mortgage, it's all about statistics. Who forecloses the most? Condominiums. Who forecloses the most as far as homeowners? First-time home buyers. I mean, statistically, material findings that they have with foreclosures and defaults, they have these types of statistics, which therefore creates rules. So that's the reason that
Mhm.
that number is important. Okay?
Mm-hmm. Yeah.
But still, you have this option. So if you get the phone call, if you're listing a condo or selling a condo, working with a buyer, and you get the phone call, my mortgage company has an issue with this. If they're putting 15% down, or they can come up with 15% with gift funds, this is an option. You should have them give me a call before you let that kill letter go out from the attorneys. Okay? And the next thing is debt to income ratio issues. We're seeing more and more. I was on a conference call with about 150 loan officers across the country, and I was floored with some of the questions these loan officers were asking. This call was about mortgage insurance, and one of the questions was, this was from a gentleman in Georgia. I thought that max debt to income ratio to get mortgage insurance was 41%. And it floored me, because that is not the case at all. For somebody in this profession to have that 41% number, they're telling people at 42, 43, 44%, sorry, I can't approve you. And that's hurting the realtors that they're working with, because there are definitely situations where I've gone up to 48, 49 for mortgage, with having mortgage insurance. So with debt to income ratios, if they call the more traditional, bigger banks, they're gonna have some of these 41, 43, 45% limits or caps, what we call them credit overlays. We don't have those. As long as I get Fannie Mae or Freddie Mac to approve the mortgage, my mortgage insurance companies, I work with 6 of them, they will approve if Fannie and Freddie approve. So there's not like a double underwrite. We don't have to, okay, here's this underwriter, okay, here's this underwriter. It's one underwriter, and once that gets approved by Fannie Mae or Freddie Mac in our system, then the mortgage insurance just comes through with it. And again, we can go up to 49, 49.99 if we really need to sharpen up the pencil a little bit. But there do need to be some compensating factors. I'm not gonna get a 620 credit score with 5% down at a 49.99. But if you have 760 and you're putting down 10%, I'm definitely gonna be able to work with that.